Welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo from Rate. I have an exciting episode today to discuss where interest rates are, what happened over the past week. We're going to discuss why the Fed matters so much, particularly right now. And then for our Did You Know segment, we're going to get into some alternative loan types that could be beneficial. This one goes out to you, self-employed business owners and real estate investors. Let's get into it. Welcome back to Mortgage Markets and More. Again, I'm your host, Peter D'Angelo. I hope you're all having an amazing end to your week. We're going to dive right in. There's a lot of information to go over because there's been a lot that's happened over the past week, and I get to have some good news. I'm always excited to start the episode with that. Without further ado, let's talk about where the average mortgage rates are today as of recording this podcast the Thursday morning before it's released, and according to Mortgage News Daily survey of average mortgage rates across the country. The 30-year fixed-rate mortgage is averaging 6.76%. The 15-year fixed-rate mortgage is averaging 6.22%. The 30-year jumbo fixed-rate mortgage is averaging 6.98%. The 30-year FHA mortgage is averaging 6.18%. The 7/6 SOFR adjustable rate mortgage is averaging 6.42%. And that 5/6 SOFR adjustable rate mortgage, according to bankrate.com, is averaging 5.94% today. Across the board, mortgage rates are down. We're coming up to 7 weeks of declines on our average mortgage rates, which had a little bit of a bump last week, but now we're starting to see more progress downward. Why did this happen? I'm going to reiterate the impact of the CPI, the Consumer Price Index. That inflation report from last week still was digested by the markets, and more people started trading along the lines that were appropriate for that. And so we saw some more relief on interest rates for that reason. We also received the initial jobless claims last week after the recording of the episode. The initial jobless claims came in at 220,000, which is slightly lower than the previous reading, which was 225,000. In addition, other economic data that we received was the Producer Price Index. This is known as the PPI. And again, that is showing us what the people who are selling the products, services, and goods, what their costs are. So any increase there normally gets translated to increased cost to the consumer that gets reflected in that CPI report. Well, that came in just a bit lower. So the headline number came in at 3.2% price appreciation year over year, and that's down from the previous reading of 3.7%. And the core, which is excluding the volatile food and energy elements, that came in at 3.3%, slightly down from 3.4% on the previous reading. So we're seeing some progress on inflation, and this is kind of normalizing after inflation did tick up. So this isn't cause for a ton of celebration, but this is movement in the correct direction. We also yesterday, Wednesday this week, had the Fed announcement on their monetary policy. That policy remained unchanged. This is pretty much what everyone was expecting. Nobody was expecting a rate cut. But what was important was the commentary from Fed Chair Jerome Powell after the announcement of their monetary policy and what their analysis was for the year ahead. And this showed us the most glimmer of hope that we've had this year when it comes to further rate cuts. At the end of last year, we saw a 100 basis point cut from the Fed in the latter quarter of the year. They cut their interest rate and mortgage rates went up. Right now, the market is expecting about 3 rate cuts. However, the Fed mentioned that the consensus of all of the Fed governors who sit on the board for the Federal Reserve, the consensus there was 2 rate cuts here in 2025. When that will be is indeterminate. It's going to be a factor of what we've talked about at length in the past. It's going to need to be a situation where we see inflation continuing to cool on a consistent basis, getting closer to their 2% target without negative impact to the job market and without causing roiled economic climate. So if we can see inflation and labor stay stable and inflation go down, that will cause the Fed to move forward. We're going to get into this in quite a bit more detail in our next segment because we talk about the Fed nearly every episode. And I was thinking, I don't know that we ever spent the time to really delve in to why the Fed matters so much. So we're going to get into that a little bit more today. Some of the other things that are playing into the markets that are not the tangibles, not the economic data and reports, one being recession fears have kind of stoked up again. We talked about that last week, and that narrative has continued. So as the talks about tariffs and how that could create a further inflationary environment, meaning prices will continue to go up for the American consumer, while that's been part of the discussion, there are significant concerns that these tariffs and some of these changing economic climates could be headwinds to inflation progress. And if there's headwinds to inflation progress and we stay in this higher rate environment for longer, it could precipitate a recession because of the squeeze that this is putting the American businesses on, as well as the American consumer. The inflation trends are another thing that was impacting the market. We discussed this, but it is worth reiterating because inflation data is so very important to how the markets are trading and the anticipation of Fed rate cuts because the inflation piece is such an integral part of that. So that will continue to happen, and I'll keep you updated as these things continue to develop. This is a very fluid situation we're in here. So it's very important that we are checking in on these things on a weekly basis. So now let's go into our exploratory segment. Today we're going to discuss why the Fed is always in our head, especially right now, and we're talking about mortgages, so why are we talking about the Federal Reserve so much? Well, we're going to get into that. The Federal Reserve establishes their Fed fund rate. Now, the Fed fund rate establishes short-term borrowing costs. Part of the mechanics of how that works is the Federal Reserve actually lends money to banks. So banks will sometimes borrow money from the Federal Reserve. Now, when I say banks, I'm not just talking about your brick and mortar bank down the street or your large Chase, Bank of America, Wells Fargo, whatever it may be. I'm talking about those banks as well as the smaller banks. They all sometimes or routinely borrow money from the Fed, and the Fed sets that rate. Right now, their policy rate, the Fed fund rate, is at 4.25% to 4.5%. It's always within that margin. And with a Fed fund rate there, okay, 4.5 is that rate. So it's costing the bank that much money to take the money. And then the bank is going to lend out that money. So when they lend out that money, whether it's short term or long term, all they have right now is what that money's costing them. So they're going to build in what's called their margin on top of that. The bank needs to make money too. So you're going to see that these short-term borrowing costs have an impact, sometimes directly on lending, but sometimes based on the banks and how they're managing their balance sheet and their liabilities so that they can manage accordingly. If the money is costing more from the Fed and they rely heavily on the Fed, you're going to see the borrowing costs at those institutions go up. So that's a tangible direct impact. The 10-year Treasury yield is another factor that the Fed influences with these short-term borrowing costs. We've talked about bonds in the past very briefly. I'll just review. You can think of bonds as the government borrowing from investors, from American consumers, from anyone who's going to buy those bonds. The bonds are a promise to pay back the money at a fixed value at the end of the term. And then however that bond is purchased, however much money that bond is purchased for, dictates the yield of that bond. That's why we look at the Treasury yields every week. Looking at the bond market, this also is much more closely tied to interest rates because the 30-year fixed rate mortgage is pretty closely tied to the 10-year Treasury bond. The logic behind this is even though you may be asking, oh, well, if I'm going to have a mortgage for 30 years, why are we not looking at a 30-year bond for that? And that is a great question. The common or conventional wisdom behind that was the fact that most Americans actually only stay in their home in a around 5 to 8 years. And historically, that's been the turnover where people outgrow their home and have to move. So the mortgage rates for 30-year lending, because the trend of history was showing that those 30-year mortgages were not actually performing for 30 years, that debt would be refinanced. That debt would be paid off when the clients or the homeowners move to another home. Well, they're going to adjust the interest rate. So the interest rate's tied more closely to what we call the time horizon that the homeowner is expected to be in the home. So that's why the 10-year is the market indicator that we'll look to so closely for the 30-year fixed rate mortgage. The Fed also has a couple levers that they pull. The Federal Reserve is there, and they're meant to ensure a stable economy, a healthy economy, and when the economy moves in a direction like it did in 2022, where we saw inflation go up tremendously and very quickly, they needed to step in. So some of the levers that they pull are to increase that short-term borrowing cost to tamp down on the growth, which is meant to slow inflation. That being said, that was really, in my assessment, a little bit of a reaction to a long-standing policy that was more so in reaction to the 2008 financial crisis. That is a time where the Fed used something called quantitative easing. And quantitative easing, you may have heard about on the news. I want to break that down for you. So quantitative easing is a monetary policy tool that's used so that the central banks can stimulate economic growth and increase money supply. Now, the second half of that's the tough part, and that's part of the reason why inflation did go up so high. If we think back, in 2008, the Fed dropped their policy rate, their Fed fund rate, to zero or near zero to help stimulate an economy that was in financial ruin, for lack of a better term. So quantitative easing is what they used. This means, number one, asset purchases. That means that the Federal Reserve is actually buying back large quantities of securities. Typically, we're talking about government bonds and mortgage-backed securities. When they step in as a buyer, that raises the price because they're a competitor in that marketplace. When they are a competitor in the marketplace, then the price goes up, the yield goes down. The yield is where interest rates lie. So when they step up, yield goes down, and that creates a lower lending environment. The second one, increasing money supply. If they are injecting money into the economy, the central bank is creating funds to purchase these securities. So it's a little bit of a double compounding effect with that. Then you have their actual Fed fund rate, as I was mentioning, where they lower their benchmark interest rate, and that creates a more affordability. And more affordability means people spend more money, and it stimulates the economy. All of these factors lead to economic stimulation, which is the last part, which is mostly the goal of what quantitative easing does. Now, we had, from 2008, we had the great financial crisis, and the Fed used quantitative easing to lower mortgage rates and stimulate the economy, stabilize the economy. In doing so, they created a historically low interest rate environment. And that was an environment that persisted for the better part of a decade and a half. Only until 2019, 2018 did we start seeing mortgage rates start moving upward to what I would call a more healthy, balanced environment. Then the COVID-19 pandemic happened. And what happens? Well, we had another problem in the economy. So the Fed steps up, and then they implement quantitative easing again, and they do the same thing that they did in 2008. But after you have a decade and a half of doing what you did in 2008 and then do it again, that makes it much more painful, and it creates this environment that we see that's a very difficult and complex situation to get out of. See also how sticky inflation has been since inflation went up so high. Now, bringing it closer to our current history here with the Fed, in 2022 to 2023, that's when their rate hike started. When inflation went up, just as they needed to stimulate the economy before when it was in trouble, well, when the economy was doing very, very well, but we had a high inflationary environment, the Fed needed to step up, increase their benchmark lending interest rate, and then start peeling back their money supply. They started peeling back how much they were going to be a buyer in the market for government-backed securities like bonds and mortgage-backed securities. So when they started pulling back, that created space in the marketplace for other buyers. And if that demand's not there, the yield goes up. Yield goes up, interest rates go up. So we can kind of get a sense now of how these things operate. And the reason why the situation that we find ourselves in is so complex and difficult to navigate out of from an economic policy standpoint. Now looking ahead. So now we just discussed everything about the Federal Reserve. We discussed how they've operated, what they do, and their tangible effect on the market and mortgage interest rates. Where we find ourselves now and what we just discussed earlier in the episode can make a little bit more sense. We are seeing that now the Fed is paying attention to the inflation data, paying attention to the job market, and they really do need to see inflation come down before they can start lowering their interest rate. This is where I'd like to highlight again. I mentioned it last week. It's so important to understand. We're still in a very volatile environment. The Federal Reserve, straight from the horse's mouth yesterday, Fed Chair Jerome Powell mentioned their consensus is that there's 2 rate cuts ahead based on the current economic climate and what they can forecast. 2 rate cuts. The market is expecting 3 rate cuts. It's not the same. As long as there is not harmony between these two things, we're going to be in a volatile environment. We can see interest rates go down. I can say just before I started recording this episode, I took a look at the bond market after I put them on my outline to report to you. Bond market's already reducing from where it was earlier this morning. So there's going to be more effects, and as people start to digest every single word that Fed Chair Jerome Powell said yesterday at his press conference and in his response to questions from reporters after his policy statement from the Federal Reserve. As a quick note, there were 2 governors that were reported out in the conversation yesterday that actually expected 3 rate cuts. So even though the Fed consensus is 2 cuts, there were a couple dissenters that believed that there could be 3 cuts this year. That being said, that wasn't the majority because the consensus was 2 cuts. So as long as these things continue to happen and the market has different expectations, we're volatile. Again, I'll reiterate, this is the opportunity time. Not to mention, we're almost in April. We are getting into squarely the spring market. As we go into the spring market, now is the perfect time, especially if interest rates are reducing, to refresh your pre-approval. If you were a prospective home buyer, if you're a real estate professional, this is the perfect opportunity for a reason to call, for a reason to chat and check in with your prospective buyers, the fence sitter sellers who were waiting for lower rates. We have another opportunity coming here. We don't know how long this opportunity will last, though. All it could take is another data point or another comment from someone on the Federal Reserve Board or further commentary from Fed Chair Jerome Powell. The markets can react negatively. So as long as we have what we have right now, it's a wonderful opportunity. And we're starting to see ourselves approaching lows of 2025 for our mortgage rates. All the more reason to get prepared and maybe get into the market and be as aggressive as you're comfortable with within your budget. So reach out to me if you want to revisit or if you'd like to have further conversation on that. For our Did You Know segment today, we're going to discuss non-QM loans and how they work and who they're beneficial for. Non-QM. First, let's start off there. Again, acronym city, here we come. Non-QM means non-qualified mortgage. So non-QM, non-qualified mortgage loans, cater to the borrowers that don't fit the more rigid guidelines for Fannie Mae, Freddie Mac, and the FHA. And those are government-backed mortgage programs. Non-QM loans are not government-backed. Now, that doesn't necessarily have much of a tangible difference other than the fact that there are some mechanics when you have a government-backed loan. There's certain safeguards. But there are lending guidelines broadly that even if it's a non-QM loan, there is a safety and security that's built into how the lending environment currently operates in the United States. These non-QM loans offer alternative ways to qualify and alternative ways to verify income, creditworthiness, and they could be valuable options, particularly for self-employed borrowers, business owners, and real estate investors. I'm going to first talk about bank statement loans. Non-QM bank statement loans are a very popular type of non-QM loan. These use bank statements and deposits actually received by a self-employed individual or business to generate a qualifying income number, and we do that by reviewing anywhere between 12 months of bank statements all the way out to 24 months. Generate what the cash flow looks like, and then apply an expense ratio factor. And that essentially takes that gross number of what all those deposits gathered over 12 to 24 months looks like, and then lop off a percentage of it as an expense ratio, because every business has expenses. There's a couple different ways that operates. One way is just through the guidelines of the program. I can speak to what we offer at Rate. We have a handful of different investors. We also have some proprietary programs for non-QM loans that just have guidelines and say, well, we're going to just apply a 50% expense factor, which means we take 100% of the deposits gathered, average it out, and then cut it by 50%. That gives us our effective income. There's also some guidelines that permit for us to engage with the CPA of the business owner or self-employed individual for them to provide us with the expense ratio. They would have to provide us with something, but that is something that is a way that we could navigate around having to take out 50%. It's a possibility, but out the gate, normally we're just taking 50% of the gross deposit average, and that's becoming our qualified income. The documentation, again, this is 12 months or 24 months of bank statements that's required. The pros of these loans, well, it's giving you a little bit more flexibility on the income verification. You know, if you have a business and you have a great accountant, they're identifying as many opportunities to write off expenses for you as possible to lower your overall tax burden when you file your taxes. Well, if you do that, our conventional guidelines, which are set forth by Fannie Mae and Freddie Mac and the FHA, they require us to use your net income as claimed on your tax returns for qualifying income. So you can make $1 million a year, but if you write off $990,000 in expenses, well, you only have $10,000 worth of effective income. That may not translate to what you actually feel by way of income, but in a case like that, these non-QM loans could be a great alternative for us to review and explore. There's also a faster approval process with these because we're not verifying through multiple different methods. It's kind of exclusively on your bank statements and maybe a letter from your accountant. That gives us some flexibility on our timeline. We could move quite a bit quicker on that approval process. Also, this opens up homeownership opportunities. So for those who have been self-employed for a number of years, have a well-run business, and they have stable income by way of the deposits coming into their bank account, but they write off a lot of expenses, this can actually be the difference between not buying a home and buying a home. So it's a very helpful program, especially now. Now you're probably thinking, hey, this is all great news. What's the catch? Well, here's the catch. It's more expensive. These mortgages are normally carrying a much higher interest rate, but not always much higher. There are ways to mitigate that. So some of them do require higher down payment amounts, around 20%. Most require a much higher credit score than the minimum required for Fannie Mae, Freddie Mac, and the FHA. Somewhere it could be between 680, 700 credit score, middle qualifying score. So these are some other hurdles. But if you put more money down, remember, mortgage rates, beyond the market component, which we talk about every week, they are also very unique to you and your financial situation. They're called risk-based priced. The risk is based upon your loan characteristics, your down payment amount, your credit score, your debt-to-income ratio, how much money you have in reserves. All of these things play a role. So if you have a lot of money in reserves and you're putting a sizable amount of money down, and you're leveraging one of these bank statement loans, your interest rate doesn't necessarily need to be much higher, or you have the option, as we talked about a few weeks ago, to leverage discount points, to absorb whatever is affecting your mortgage rate and pay a premium up front for a lower interest rate or a closer to market or market interest rate by paying those discount points up front while you're leveraging one of these non-QM loans. So who benefits? I already mentioned. We talked about self-employed, gig workers, business owners, and the one group that we didn't discuss because we were focused on our bank statement loans are real estate investors. Real estate investors can benefit from non-QM loans because there's also a very particular loan program available that's called a debt service coverage ratio loan. That is DSCR. Remember? Acronym City. We're here again. So DSCR is exactly what it sounds like. We qualify essentially based upon a client's or a real estate investor's asset position, how much money they have. This is inclusive of reserves and the money they'd need for down payment and closing costs. Their credit score. You need to have a higher credit score for these loans. And what the cash flow is for the property. That's it. We do not delve into personal finances other than what I just outlined. If we are able to verify those things and the property that the real estate investor is interested in purchasing cash flows, which means if it makes sense for you as a real estate investor, it makes sense for us. If you are obtaining a property and it's cash flowing where your mortgage, principal and interest, taxes, insurance costs are less than what the gross rental amount is for that property, that's your approval criteria. You're good to go. Again, those loans do carry with them higher interest rates, sometimes by a large factor, but sometimes not. There were times, and I can say for some real estate investors I've assisted over the past few months, that comparing these non-QM DSCR loans to your Fannie Mae or Freddie Mac conventional investment property loans actually come out ahead. You come out on top doing the DSCR loan. So it will depend largely on credit score, largely on down payment amount. The more money you put down and the more money you have in reserves, the better the terms are going to be for your mortgage rate. So your interest rate could be lower if you have strong qualification factors for all of those things. My final thoughts on non-QM loans. They are a great option, especially if you've run into no. So I have a message out there today for anybody who's listening, who has tried to get approved for a mortgage and have been turned down by banks who've only looked at conventional and standard ways of qualification. This is your call to action. Reach out to me, follow me on socials, reach out to me via email. I can possibly help you here because these loans are tremendously powerful. They do take quite a bit more on the front end so that we can ensure all of our ducks are in a row. But then again, that's the proper way to do business in this current competitive environment. If you are getting your financing put together, you're going to want to make sure every box is checked, every stone is uncovered, and everything is buttoned up nicely so that when you place an offer, you have every bit of confidence that you won't run into issues moving forward. Lastly, for our little fun fact here today, I want to talk about sand sounds. We're starting to get into warmer weather, so my fun fact today is that different sand from across the world sounds different. It depends on the size of the granulars of sand and what the sand is comprised of. But we're getting into the summer. I'm already in the mentality of summer vibes. Sand sounds differently across the world. I thought that was very interesting and fun. So I hope you can use that for some fun conversational fodder. Thank you all so much for listening today. I hope you found this information helpful and useful. I look forward to giving you an update next week. Heads up, we've got our National Association of Realtors existing home sales data. That came out today, later today of recording this episode. So I will have that information for you next week. In the meantime, follow me on socials. Reach out to me if you have any questions. My email address is peter.d'angelo@rate.com. I hope you all have a great Friday and an awesome weekend. Take good care.